In tax planning, deductions come in two flavors. First are your tax deferral strategies. These include things like retirement contributions, like-kind exchanges, installment agreements, etc. These are tax deferral strategies because you get a deduction today, but sometime in the future you'll potentially have to pay tax on that income. Second are permanent tax deductions, where you get to write something off today and you never have to pay taxes on that income. Whenever we can, we want to take full advantage of permanent tax deductions. The qualified business income deduction is a permanent tax deduction, and as of now is only available into 2025. As stated in part 1, high taxable income is about $321,000 for married couples filing joint and about $160,000 for people filing by themselves. If your income is above that threshold, that means that you're in at least the 32% tax bracket, if not higher. So let's do a little math. If you have $100,000 of qualified business income and the qualified business income deduction is 20%, that's $20,000. If you multiply that by your marginal tax bracket of 32%, you have a potential tax savings of $6,400. That's a compelling reason to want to max out your qualified business income deduction. As stated earlier, by the time you get to the upper taxable income limits, you'll receive no deduction unless you adhere to the W-2 and qualified business property limits. Those upper income limits are $210,700 for taxpayers filing single or head of household, $210,725 for taxpayers married and filing separate, and $421,400 for married filing joint. If your taxable income is above the aforementioned taxable income limits, your qualified business income deduction, QBID, cannot exceed the greater of 50% of W-2 wages paid or 25% of W-2 wages paid plus the unadjusted basis of qualifying property. I'm gonna take a moment to let that sink in a little bit. Unadjusted basis of qualifying property generally means any piece of property, whether it be real estate or personal property, that you get to depreciate under makers. Please note there are exceptions that will disqualify certain property. Unadjusted refers to the original cost basis of that piece of equipment as opposed to its adjusted basis after depreciation. The property will typically qualify for at least 10 years from its original place in service date, though assets with longer than 10-year lives will qualify for their full depreciable life. Again, if your taxable income is above the projected to be above the taxable income limits, it's imperative that you take a second look at your tax plan. With you being in the 32, 35, or 37% tax brackets, you'll be leaving substantial money on the table if you get this wrong. Hey everybody, thank you so much for watching our video. If your business is in the greater Orange County or Los Angeles areas and you're looking for a tax and accounting firm that truly understands small to medium-sized businesses, please give our office a call. Otherwise, if you just like our content, please like, share, subscribe, or comment. Thanks again and have a profitable day.